Hello everyone, my name is Anthony Vokes and today I've got with me Giles Lang, and we're talking today with a follow-up following our budget seminar we did a couple of weeks ago regarding the various very significant changes that happened in the budget at the end of October. And today we're going to particularly focus on the inheritance tax changes, with a particular focus on the APR and BPR changes. We've been having a lot of meetings, having a lot of phone calls with clients, clearly very concerned. So today we're going to talk you through a bit more detail on the changes and also some of the planning opportunities that we're seeing, some of the action that people have been taking.
Thank you, Anthony. I'll firstly start with a recap of the key changes following the budget before we delve deeper into the agricultural property relief and business property relief reform. First up, we have the nil rate band allowance that we're all used to, at $325,000, has once again been frozen until 2030. This will be 21 years since the previous increase.
That's incredible, isn't it? 21 years of frozen allowance. I've never known that in all my time in tax. 21 years. I mean, the difference in the value of money in 325,000 from 21 years ago to now is incredible, isn't it? The house prices alone.
Yeah, absolutely. And that's what I was thinking. House prices in the last 21 years have increased substantially. And again, we look at the residence nil rate band of £175,000. That has also been frozen until 2030. A newer allowance, it came out a few years ago. I think by 2030 it will be in for 9 years at that point, which allowed you to transfer a main residence direct to your descendants. You could get this relief, but there is a crutch that if your estate exceeds the £2 million mark, then that residence nil rate band is tapered. For every £2 exceeding 2 million, it's reduced by £1.
So the net effect of that is that what we all think of as a 40% inheritance tax rate, actually between 2 million and 2.35 million, it's actually a 60% net effective rate.
Yeah.
Because you're paying 40% and you're also losing your residence nil rate band.
Yeah.
Then the effective rate is 60%. So, I mean, that is something that we really need to focus on now going forward, especially with the massive pension changes.
Yeah, absolutely. Which brings us on to the pension benefits change. Previously, a very useful tax planning tool to shelter value from your estate for inheritance tax purposes will now be brought within your estate with effect from April 2027. We will be producing a video on this, which will be issued shortly.
But I mean, the very consequential change, this one, for people that have built up big pension pots, and like I said, we'll talk about this in more detail later, but for people who've built up big pension pots thinking that was a good thing to do, a safe thing to do, actually no, that this has changed things, that the landscape massively for them.
Yes, and what we're here to really discuss today is the agricultural and business property relief reforms, which will take effect from April 26.
Yeah, so just turning to those, so the APR and BPR changes that are coming in with effect from 6th of April 26. So at the moment, if you've got a business, you will generally qualify for 100% business property relief, so long as it's a trading business, which will often mean that there's no inheritance tax at all payable on your business. But with the new rules, the relief is going to be significantly restricted. So you will only get the first £1 million at 100% rate of relief, and thereafter you will be taxed at an effective rate of 20% because the relief is 50% with a 40% inheritance tax rate. So it gives an effective 20% tax rate.
And that £1 million is a combined relief.
Yeah. So if you've got both, and some of our clients will have this, they've got both a business, they've got a limited company that qualifies for business property relief, and they might also own farmland, which qualifies for agricultural property relief. Well, you don't get 1 million of APR and 1 million of BPR, it's a combined relief. So just something to watch for there. The AIM market. Historically, the AIM market hasn't always performed that great. One incentive to invest in the AIM market has been the fact that the shares qualify for 100% business property relief. So people have historically sheltered assets in the AIM market in order to try and get that relief. Well, now the relief has been reduced to 50%. So again, an effective 20% inheritance tax relief on AIM market investments. So what would this mean? So if you've got a business valued at £10 million, or indeed a farm valued at £10 million, so at the moment you would typically, as long as you're a wholly or mainly trading company, you would get 100% business property relief, meaning that there would be no inheritance tax at all on passing that business down to the next generation. But with the new rules, as I mentioned, you only get £1 million at 100% relief, and the remaining £9 million is taxed at an effective rate of 20%. So you end up with a rather larger bill of 1.8 million. And you'd have to question how many businesses will finance that. Because if the estate doesn't have liquid funds to pay the bill, then it's going to need to come from the company. So that could be a dividend, there could be income tax payable on that.
And worst case scenario, liquidation of a company to finance the inheritance tax charge.
That's right. I suppose one important thing that we do need to bear in mind is that there are 10 years of instalments available from HMRC, and it's interest free. So in a lot of cases, I'd imagine you pretty much automatically take those instalments, especially with them being interest free. So that is one relieving element that might help. So as I said, we've had a lot of meetings with clients. We're having a lot of phone calls with clients. So we just wanted to talk a little bit about some of the planning opportunities that we're seeing. We have a window of opportunity at the moment before the rules are fully implemented in April 26. We are seeing direct gifts of assets during lifetime. So this might be shares in trading companies, this might be farmland. So a gift of those to the next generation will need a 7-year survivorship period to be fully effective. But if you survive for the 7 years, then generally the IHT position is secured. If you make a gift of assets, it would normally be liable to capital gains tax, but there is normally a relief available called holdover relief, which can apply to trading companies with a few restrictions. One being if you've got a company that has a mixture of trade and investment, that can be a bit more tricky. But if you've got a standard trading company, or if you own farmland, then you will probably qualify for 100% holdover relief, which will mean that you can pass those shares down with no capital gains tax. What you will lose is, at the moment, if you pass away with business assets in your estate, you may pay inheritance tax on them, but there is a tax-free uplift for capital gains tax purposes on the base cost of those assets. So when your successors inherit those, they inherit them at probate value, which means that they only pay capital gains tax on any uplift from that point onwards. That can be really useful. And I mean, it has been a really good planning tool over the years to keep the business with dad or granddad until they pass away, so that as part of their estate, they might have got 100% business property relief, so no inheritance tax, and also the tax-free uplift for capital gains tax purposes. So it was almost like a double relief. So that was one of the things that I thought they could do. They could remove that tax-free uplift, but they haven't. They've gone after the inheritance tax side instead. But yeah, of course, if you make those gifts during lifetime, then you will not get that tax-free uplift on death. The other option that we're seeing, the other thing that we're looking at is using trusts to effectively do the same thing. So these are people settling assets into trust, so they cannot benefit from them anymore after they've given them to a trust. But what they will do is they will retain the trustee rights, so they effectively control the assets still for the benefit of their children or grandchildren. So this can be appealing to some people, where perhaps they don't think that their children are quite ready to run the business yet, so that the trustees will still control the voting rights on those shares, which is quite useful. Also quite useful if son or daughter maybe has a difficult marriage and maybe gets into marital difficulties, the shares can be protected in a trust, whereas if you've given them directly to the next generation, those shares or assets would be in the pot for any sort of divorce settlement, which again is not very appealing. Which is another reason why trusts, I think, are going to become even more popular than they ever have been before. So if we get beyond the 7-year period, the gift into trust is effective for inheritance tax purposes, but watch out for the 10-year anniversary charge, which my colleague is going to talk about later, because there is inheritance tax payable by the trust every 10 years.
And something we will be talking to clients about is, have they updated their wills? We're all aware of the spousal exemption on first death, that assets can be left to your spouse completely tax-free, and also the nil rate band allowances can also be transferred to your spouse following first death. But that doesn't apply to the agricultural property relief and business property relief £1 million allowance. So it will become more important now to potentially write this into trust within your will, and so you can benefit from this this £1 million allowance. Otherwise, you risk losing it completely.
So this is a really critical point. So if we've got businesses that maybe are owned by dad, we will want to change that so that the spouse has some ownership of the company as well and uses their £1 million allowance. That's really important. It's not transferable. So that'll be something that we will be talking to all our clients about.
Yeah, and a review of the ownership of a business. If dad owns 100% of the business, is it time to bring wife in at 50%? So at least they're making use of all the allowances between them. And a question that I have been asked by clients is, leaving the UK a possibility?
Yeah, I've had many questions on that in the past few weeks. You've said practicalities, which, yes, I mean, practicalities are, vastly challenging. And also I'd question whether it can work in the way that people think it can. Just to follow up with an example, we talked about lifetime gifts to family members. So I'll just explain what impact that might have. So if we were to gift shares in the trading business valued at 10 million to the next generation, for capital gains tax purposes, so long as we're a trading company with no investment assets, we will qualify for full holdover relief, which will mean that there's no immediate capital gains tax charge. The next generation will effectively inherit the original base cost of the donors, but there's no immediate capital gains tax charge. The gift for inheritance tax purposes is called a potentially exempt transfer, a PET, which requires a 7-year survivorship period to fully escape IHT. But there is a bit of a sting in the tail at the moment because of the new rules. They come in 5th of April 26. So if unfortunately we make a gift now but we don't make it the full 7 years, then it becomes a failed PET, and the new rules will apply on that failed PET, which will mean that we'll only get the 100% relief on the first million and 50% relief on the remaining 9 million. Whilst the new rules don't come into play until April 26, they still are already applying and need consideration on gifts and transfers into trust.
We did touch on this subject earlier about gifting to family members and having that control. By doing this, you're losing that control of the business, and a lot of people don't really want to do that.
Yeah, if you're making lifetime gifts of farms or businesses, lock, stock and barrel at this time, then you just need to bear in mind that once it's gone, and you're not in control anymore. So people will be. I'm seeing partial gifts now. Maybe mum and dad keeping majority control, but accelerating any succession planning that they might have been thinking about, or they're going down the trust route where they can maintain control. So yeah, lifetime gifts into trust. So again, just to talk this through, we think this will be a very useful opportunity for people. So trust will also receive a £1 million BPR or APR allowance. And if you've got a trust that you've created before the 30th of October 24, that will have its own £1 million allowance, which won't be split. Whereas if you've created the trust after the budget, 30th of October 24, all the trusts that you create from now on will only have one allowance, which they'll split between them all. So if you've got trusts that you've set up before the 30th of October 24, they are very useful, and we'll certainly be looking to use those in planning. So again, to look at an example of how it might work. So if we if we transfer shares at a value of 10 million into a trust now, we'll benefit from the existing rules with 100% business property relief, which will mean that we have no immediate inheritance tax charge on making that gift into trust. There is again a special form of holdover relief for capital gains tax purposes. In fact, this form of holdover relief can also apply to companies that are a mix of trading and investment, or indeed purely investment. So it can be very, very useful. So if you've got companies with investments, then you would be looking at this route to try and get the relief. Trust, however, there is a sting in the tail. Whilst there's no inheritance tax at the outset, there is potentially an inheritance tax charge every 10 years, called the 10-year charge, or also the exit charge if you take the assets out of a trust. So if we create a trust now, at the end of 10 years, we would need to value the trust fund at that point. It will only have a £1 million BPR allowance, and it will have 9 million, therefore, in the charge at an effective 50% relief rate. So in that case, we would have 4.5 million in the charge to tax, but the rate for a trust is only 6% every 10 years. So that's probably a far more palatable bill of 270,000 compared to the 1.8 million if mum and dad had kept the shares in their own name. So a much smaller bill, and typically at the end of 10 years, you might run it for 10 years and then you might pay your first 10-year charge, and then that's a really good opportune moment to close it down. Maybe son and daughter are a bit older then, maybe they are ready to take the business forward. So that could be good planning to run the trust for 10 years and then reassess the situation. Then do we still need the trust, or can we close it down?
And also trust created prior to 30th of October 24, which have this £1 million allowance anyway, and they qualify for business property relief or APR relief. If they're coming up to their 10-year charge, which goes beyond the 6th of April 26, it may be a possibility to then distribute those assets out to beneficiaries without a tax charge.
Yeah, absolutely, yeah.
And finally, leaving the UK. There has been some rules on this that have changed. Previously, we would look at the domicile of an individual. Well, that's no longer a factor. It's now much easier. It's all residency based. So what's the residency status? And to become non-resident, you have to be out of the country for 10 out of the previous 20 years. But it only applies to non-UK assets, which will be excluded from IHT. Your UK assets will continue to remain chargeable.
So, I mean, someone that's been a UK resident for all their life, if they want to get outside of the UK IHT net, they basically have to leave the country for 10 years.
Yeah.
So, I mean, it's quite a big, long commitment to achieve what they're looking to achieve. And then, like you said, UK assets are still within the charge. So, I mean, that's easy with liquid assets like cash and stocks and bonds and things.
But trickier with properties or businesses that are in the UK.
Trickier with UK properties, and there's a lot of anti-avoidance about UK properties and offshore people anyway. So typically, if you've got UK properties, moving overseas is not really going to help the position due to all the anti-avoidance. Yes, a lot of people are thinking about this, looking at this. There's a few particular destinations that people all seem to mention, Portugal and Dubai, Dubai being the main one at the moment. But actually, practically, it is quite tricky. It takes a long time to achieve. And if your main assets are UK property, it's not going to be as effective as you think it is.
And some final thoughts. We'd say that let's not make any knee-jerk reactions. We've still got time to plan. We have 16 months before the legislation becomes effective. During that time, there is some technical consultation in early 2025 with legislation being published later. We don't know whether there will be any changes or whether it's going to remain what we know what it's going to be now. The devil is always in the detail.
Yeah, I mean, the government are that they've had an awful lot of criticism over all of this. So it'll be interesting to see what the technical consultation says, whether they block some planning opportunities that we are looking at the moment. So I think it's really critical not to make knee-jerk kind of fundamental life-changing decisions at this time. I think, but by all means, let's talk to your accountant. Let's think about it, but probably anything too drastic at this moment probably isn't a good idea whilst we're still waiting for the technical consultation. But yeah, as you say, the devil is in the detail, and we'll wait for that to come in the new year, and we'll obviously keep you up to date with what we hear as and when it comes out. We're having many meetings with clients at the moment, who are obviously very concerned about the rules that are coming in, but probably not time for anything too drastic at the moment. But we'll certainly keep in touch with all of our clients on what's happening. If anybody's got any queries or questions, then please do come back to us. We'll be happy to speak to you, or please do speak to your usual Right Vigor contact. Thank you very much, and goodbye.
Goodbye.